All right. Hello, everyone. We are live here on Crowdcast again here at Techstars. Thank you for joining our weekly AMA with David Cohen. Today, we have a very special guest, Brad Feld. It's rare that we have both of them at the same time, so take advantage of this. Before I pass it over to them for some intros, just some quick housekeeping. Go ahead and you can ignore them. Just go ahead and post in the chat where you are tuning in from. We're all tuning in from various parts of Colorado. I'd love to see who's online with us. And then at any time throughout the broadcast, you can submit a question at the Ask a Question box below our faces. And then upvote those two, and we'll try to get to as many as we can during this event. So I'm going to pass it over to David and Brad for some quick intros, and I think David has kind of a weekly update for us. David, you want to start?
Thanks. Yeah, thanks, Casey. I can't remember if this is number 5 or number 6, but who's counting anyway, of our weekly AMA. So glad it's been useful for people. Super psyched to have Brad with us today. Thanks for joining, Brad. Couple quick updates. As you know, every week we mention the techstars.com/COVID resource. We continue to add the latest information about how this is affecting startups. So please reference that if you would like to dig into anything in depth. There's lots of sections there that organize it for you. Wanted to mention some activity around Startup Weekend. Some of you may have been involved in those. There have been 55 countries so far that have held a Startup Weekend for COVID. Just under 17,000 people have participated across those 55 events, and 476 organizers organized them. So what an incredible community around Startup Weekend. So thanks if you were involved in it. And if you still want to get involved in one, you could check out the link that Casey's about to post, which I think is covid.startupweekend.org, if I remember it correctly, because there are still more countries coming. I think there's another 20 or so countries that have organized an event upcoming still. So thanks to those of you that participated there. Do you want to also mention a event we have coming up called Inside an Accelerator, what it's like to be in a Techstars accelerator? It's a little bit secretive, so you're here and hearing about it. You can join. Casey's going to post a link for that as well, where you can register and drop into that and learn more about what it's actually like to go through a Techstars accelerator. So those are a few updates for this week. Brad, you want to say hello?
Hi.
What else do you want to say? That's too short.
Brad Feld coming to you live from just on the edge of Boulder, Colorado and Longmont, Colorado. Very bunkered in.
Cool. It's almost like we're in one place with 3 frames here. So the ask question is down there. Don't put it in the chat because we won't see it. Chat's just for saying hello or reacting. But please upvote people's questions. And Casey, let's roll and take a few.
Casey, you're quiet. This is the new thing.
I like it, Casey. It's good.
Instead of saying, "Can you hear me? Can you hear me?" You now say to somebody, "You're muted." It's like an ad.
It happens every week. You can. David can attest to that. But I try to stay quiet. I try to not have any background noise, and I'm too good at muting myself. So I will be more aware of that this time. So this first question from Tara at the top. And Tara is asking, should you convert to a C Corp prior to seeking seed or early VC capital if currently structured as an LLC? And do legal fees get paid during the raise or all at once after the deal closes? Wondering how cash-strapped startup covers them unless out of the money raised that round. Oh, starting with a big question.
Not it. Oh, damn it, he's making me do it. Is that where I'm supposed to be? Because I'm actually on the other way on my screen. We'll figure this out eventually. Up will be you and down will be Casey. No reason for that, Casey. Yeah, look, I think most of the professional investors are going to want you to, in the US, become a C Corp and not a sort of limited liability company. You could probably raise debt against an LLC. But, I think generally speaking, they're not going to want this sort of tax that passes through and to deal with all the K1s and things like that if they're a fund. Some angels might do it. It's not a hard and fast rule. But I think it generally will open up who you could fundraise from to go ahead and convert away from being an LLC. I can't remember all the other 6 parts of that question. What were the other relevant parts, Casey?
Do legal fees get paid during the raise or all at once after deal closes? Wondering how Cash Strap startup covers them unless it's out of that round.
Usually it gets paid out of the round when the round closes, and most good venture lawyers will defer their fees until the round closes. There's a little bit of risk sometimes that a round doesn't close, but even in those cases, high quality, law firms that understand how to do VC-backed financings or even angel financings will defer their fees.
Just a quick shout out to Will's comment on, he likes the hat. It's because I attempted to cut my hair, and I'm just not going to show you that.
This is the first time in 4 weeks that I'm not wearing a dirty t-shirt. I just felt like I needed to clean up today for some reason.
All right, next question. Well, this one's a fun one. I'm going to start with Brad on this one. What's the biggest idea you came up with during this lockdown?
So far, because the lockdown's far from over.
So far.
Biggest idea. Well, I keep learning over and over again how important it is to take at least 1 day a week completely off from everything. I do this thing called Digital Sabbath, and for the first 3 weeks of this, I worked continuously, and I started to feel myself melting. I took a Saturday off, and then recommitted to it, and then had a weekend where I didn't do it and sort of felt the pain of that. And then this weekend on Saturday, I woke up and I had a couple of meetings that had gotten scheduled. So at the end of the day, Saturday, I felt really disoriented. And I took basically Amy sat me down, my wife Amy sat me down and said, you're taking tomorrow off. So just sort of, I'm not sure it's a big idea. It's just this reminder of taking care of oneself in the midst of all of this stuff. I would say, I believe maybe the big idea that I've had is we are living now in 2025. So many of the things that we are having to do or that we're using in terms of technology were things that have been around for a while, but there was no forcing function to drive towards them. And the pandemic was the forcing function. Video conferencing is kind of the easiest to point to. We went from a world where video conferencing has been around for 20 years, but it wasn't pervasive. And the idea of completely remote work and distributed work was something that, people resisted in lots and lots of places. And suddenly, all of society is having to do remote work, whether it's a good idea or a bad idea, but like the ability to do that, we've shifted to. Telemedicine would be another example. Telemedicine made 10 years of progress in 4 weeks. Technology's been there. It's not that the technology wasn't there. It's that the regulatory infrastructure and the healthcare infrastructure and hospitals and doctors, and nobody used it. And now all of a sudden you have to use it. So I think there's a very long list of things like that. There's a handful in my world from an investment perspective that I'm quite interested in. I've already seen, some of these big charts that say, here are the 15 categories of things. It's sort of interesting. I think there's so much that nobody's really thought about yet about how the nature of how we're going to interact with each other as humans, how work is going to work. And in a lot of ways, just sort of accelerated the pace of a lot of things that were on the innovation curve by 5 years.
Awesome.
Yeah, I think that's the interesting part, right? Is just thinking about how's the world going to be totally different going forward. And for me, it's not so much coming up with something totally new and novel, but it's trying to recognize it when other people do. And I think the Startup Weekend thing is an example of that. Is it's incredible leadership in the community, and you just kind of try to give it some resources and shove it in the back a little bit. And I'm seeing that across our portfolio where people are coming up with amazing new things to do. We have one portfolio company in common between Foundry and Techstars called Chalbiotics, for example, that they just know there's not going to be salad bars in the future, and it's a huge opportunity to go and position their food robots into these places. And so, they're coming up with brilliant campaigns around that and things like that. So it's just so neat to be around the entrepreneurs that come up with these ideas and to be able to help them think about them or amplify them.
It kind of leads to the next question. It's actually from the same person. If you can be both, if you can't be both, would you rather be a VC or a founder now and for the next 5 years? Who wants to start? Would you rather be a VC or a founder for the next 5 years?
Well, I decided 20 years ago not to be a founder anymore. And even though I've helped found some companies, I've put myself in the world where I'm an investor. I made this decision in the internet bubble where I was both, I think it's a false dichotomy. I was both an operator and a VC. And so I was both investing and trying to run things. I think you can be a founder as a VC. You just can't run anything. And for me, I made the choice a long time ago. I think it's, I think in the near term, if you're not a VC, I think it's going to be very hard to find a role in venture capital in the near term. It's been this way kind of coming out of every downturn, which is there's contraction. I think the inverse is true, however, is that some of the most interesting times to be a founder is in downturns. And it's cliche that a lot of the great companies have come out of downturns, but fundamentally, in downturns, there tends to be an abundance of resources available, which are not true sort of at the top of the market. And whenever there's dislocation, it generates lots of new opportunities structurally as well as conceptually in different business areas. So the ability for a founder to be, nimble, creative, adaptive, in this kind of environment it can be very high. The place that's really hard to be is running an existing meaningful business that has very clear dependencies on characteristics that are inhibited right now. So for example, if your business depends on people traveling, you're kind of screwed. If your business depends on people going to big venue events or people going to the office every day, it's a tough spot. And if you're a small startup in that mode, you have a lot of flexibility because you can decide what you want to do. If you're a 1,000-person company and you just watch your revenue go from some big number to close to zero, doesn't mean that you're out of business, but you have to think very, very differently about what you're deploying your resources that you have today against. So there's just lots of different places to be on this curve. And so I don't think it's as simple an answer as A or B.
Yeah, I love the false dichotomy comment. I mean, I like to think the founder part is huge for Techstars, Brad. I mean, this year we'll essentially co-found 500 companies, right, or many hundreds of companies. And that's really fun to be able to think about all these businesses and help them get off the ground. But also, good time to be an investor, if you have capital, because the opportunities are out there. So why pick, I guess, if you don't have to, right?
Yep.
Awesome. Next question for Brad and David. Thanks for doing this. What have been your pricing recommendations to founders during the virus crisis?
Pricing in terms of financings?
Says, for example, multiples.
Yeah, a little unclear on the question, but I'm going to guess it's about fundraising and the value you would get for next round. I'm not sure if that's what they mean.
Andre, if you are watching, go ahead and clarify, but we'll just answer that it is about fundraising.
I think that you should expect financing, says Andres. At the early stages, you should expect tighter ranges at the lower end of the typical spectrum for early stage fundings. And early stage financings have, from a price perspective, tended to be in a pretty narrow range at the pre-seed level, and then at the seed level, it tends to be pretty variable. My sense is that the challenge for an entrepreneur at the pre-seed or seed level right now is less around the valuation and more about getting attention from investors who are going to fund your company. There is plenty of capital at that stage, so it is working hard to get attention. As you get into Series A forward, there's a lot more price compression going on right now, and you're seeing a lot of situations where companies that had raised money at very, very high prices that need additional capital are seeing that capital either not available to them or at much, much lower prices. That's pretty normal that the bigger companies see more price compression, and at the earlier stage, you see more scarcity, where it's harder, sort of the supply-demand balance gets out of whack more. But I think we're early into this. I think people are still adjusting. It's 6 weeks into when I think the United States really started thinking about there was a significant dislocation. I don't pay much attention to public markets, but somebody told me the public market valuations for most tech companies, except for ones that are really in distress, are pretty close to where they were, sort of pre-market falling apart. And, given that, a lot of weird indications about what people think might happen or might not happen. So I don't know if there's a lot of predictive power in the current moment.
Yeah, we lost Casey. Hopefully she'll rejoin, but I'll drive the questions if not. The only thing I would add is, maybe it's useful to look back at, 2009 timeframe, just to give people examples, Brad. In 2009, you probably have more companies that you can list, but, we were around, SendGrid, Uber, Twilio, all in that year. And, since then we've been running at this, seed valuation sort of going up and maybe getting a little bit crazy in some cases. So say the investors anyway. But, those three deals, just to share some valuation data, right? SendGrid raised $750K in their seed round at under $2 million pre-money. Twilio at $3 million pre-money and Uber at $4 million pre-money, which was considered very high back then. And sort of watching all those, I think one thing we learned is that they built good companies, and all of those founders are quite happy, even though those valuations were maybe lower than what you'd expect. So I think the big thought here is, if you do get the attention, be flexible around those valuations and recognize it's just one moment in time, one valuation. It's not the only event you're going to have. And, if you need the capital to grow, you need the capital. So just don't be obsessed with that valuation at this early stage. Be flexible.
Well, one other historical comment, just so people have it. There's always a sense every time we go through a cycle that this cycle, things are different this time around. And I'm getting old enough to be grumpy about that and say that's bullshit. In the mid 90s, 94, 95, 96, maybe even, seed stage valuations were typically in the $3 to $5 million range, and occasionally you'd see something in the high single digits. In the internet bubble at the peak in 1999, 2000 was already kind of, it peaked in springtime of 2000, but let's say 1999, people were regularly doing seed rounds of 10 million at 40 pre. It's fucking insane. Like, makes no sense. But that was what was happening. Now, most of those investments did not turn out well. A few did, but most didn't. And post-internet bubble, you saw most seed deals, again, being done 3 to 5 million pre, which, even through, 2006 started going up a little bit. And then we had the financial crisis. And at the end of the financial crisis, 2010, 2011, back to 3 to 5 pre. So you sort of have this, cycle that goes like this. And it's not predictable where you can predict the top or the bottom or anything like that, but it does sort of always normalize back. And so I would say, if you're raising your first capital right now and you've got investors who are interested and you're landing in a $3 to $5 million price range, you should be pretty happy. And if you're higher than that, you should be really happy. And per David's point, it's not the valuation that you get on that first financing. It's the dilution you take over the life of the company. So raise the least amount of money you need to make it to the next level to get a step up, to be able to make progress with your business, versus try to optimize for specific valuation. And then go back to the venture cliche, which is the quality of your investors matter, especially at the early stage. If you have choices, that's great. If you don't have choices, then, at least if you have one choice of one, at least you have a choice of one. But optimize for who you think is going to be the best and most constructive set of investors for your company.
So we don't have Casey, so I'll play moderator, and then I'll try to get her back. One question has several votes here. What's your take on impact VCs? Does your firm consider investing in startups that prioritize any metrics other than just financial return?
David, why don't you answer that, since there's a couple of Techstars that are very specifically focused on that.
Sure, I can't get Casey back while I do that, but I'll try. So, I think when we've looked across our system historically, and today it's scaled to 500 new investments a year, we have noticed that when we pull out the companies that sort of match this impact definition, which we have a definition for, those companies as a cohort have actually outperformed the general cohort of Techstars companies, which is already quite good. So there's something about companies that are doing impact-oriented things that actually can be a very good investment, and we have the data that's sort of behind that. Because of that, we started to launch programs that are focused, accelerators that are focused more specifically on various types of impact. So we have a program in Atlanta with Cox Communications there, which is focused on impact. We have a Nature Conservancy program in Denver focused on sustainability, sort of food, water, climate change. And then, across the system, right, there are other examples, Farm to Fork, Minneapolis, and others are sort of also focusing their generalized programs, even in places like New York or LA, more and more on companies that have this other reason for being. Now, as investors, we still have, as Brad likes to describe it, the simple job: get a bag of money, return a bigger bag of money to our investors. So we do have to look at those financial metrics, but when we can get the secondary, performance, that other reason for being to do well, that feels really good as an investor, and I think everybody's excited about that. So we're trying to do more in that area. Let's see here. Looking at other questions. Maybe I'll give this to you, Brad, so I can see if I can get Casey back. Yeah, this is a good one for you. How are you managing depression amidst all of the negative news surrounding COVID-19, and any advice to others?
It's pretty hard. And, I've been open that I struggle with anxiety and depression, and there's definitely been some tough days for me in the mix of all this. I would say for me, personally, it's been triggered by fatigue, just sort of the overwhelming intensity of all the different things that I'm trying to deal with from a work perspective, and then not taking care of myself enough. I think people sort of struggle with it from lots of different perspectives. I think it's really useful to frame what we're going through as being the intersection of three separate crises. I think the first crisis is a health crisis, which is the COVID crisis, which is unprecedented in our lifetime. Nothing like any of us have ever encountered before. The second is a financial crisis or an economic crisis. I prefer to call it a financial crisis now that I sort of have my mind around it. But either word is fine. That financial crisis wouldn't exist if not for the health crisis. Our broad economy, there's lots of inequity in our economies globally, but generally speaking, we were in a time of pretty strong economy, especially around technology companies and entrepreneurial companies, but also broadly writ. And then the third crisis, which is a function of the first two crises, is a mental health crisis. We are simply not used to this as humans. Being trapped in your house 24 hours a day, 7 days a week is not what we are. It's not the way we live. It's not the way we've organized our lives. And that's independent of the fear of the virus, which, every day we are being confronted with people dying. My guess is everybody here probably now has 1 degree of separation from someone who's gotten COVID, or if not, then 2 degrees of separation. Probably everybody in this call is 1 or 2 degrees of separations from somebody who's died from COVID at this point. This is stuff that's hard to process because it's in our face and it's against the backdrop of uncertainty. We then, and depending on where you are in the world, certainly in the United States, we have very, very confusing messages from our government in the city, states, and at the federal level, partly because of dysfunction, but partly because there is so much changing information. And then people like to grab onto information that is hopeful. And so, you sort of start believing in some hopeful information, even if that hopeful information is dangerous, wrong, whatever, and then other people react to what that is. So there's just a lot of dissonance that's very, very hard to process through against this backdrop of our daily lives being massively disrupted. And that's independent, again, of anybody's individual pressure. If you're living paycheck to paycheck and you just lost your job, if you've got family members who are older and they're isolated and you can't visit them or get together with them. If you've got other family members that are in places where it's not safe from your frame of reference, that creates additional stress, and on and on and on. The question that led me off on that rant was how do you take care of yourself in this moment? And I would say it varies by person, but the first is just awareness that this is hard. Awareness that everybody is feeling real stress and anxiety, even if they don't acknowledge it. And trying to have an effort of being positive and helpful to your fellow human. Like if there was ever a moment, especially if you're a leader in an organization, where you stepped up and you tried to be empathetic to people that were struggling. If in situations that are oppositional or have conflict, rather than react to the conflict, understand that the person who is on the other side of the conflict is also under lots of stress and lots of pressure. And just trying to have a softer approach to most things. The other is to give yourself space. Make sure that you have some time and space for yourself for whatever you need. There was a great essay that made the rounds a couple weeks ago about this is not the time to become great at some new thing. Like the performance achievement goal. Oh, I've got lots of time. I'm going to go learn, French. Not the time. Like you got to spend all of your energy sort of dealing with all the stuff around you and coping with it, and like adding on that, and then not succeeding and feeling guilty just makes that even harder. So, I don't think there's a magic answer, but there's lots of things to do. And the first I would encourage everybody is to recognize that most, if not all, of the people around you are under incredible stress in this moment in time as well, for lots of different reasons. And, it's a good chance for us as humans to rise to the occasion and help each other.
Thanks, Brad. I mean, Casey has found a unique way to bail out on us. She's claiming Wi-Fi problems in her apartment. I'm sure she just didn't want to hang out with us, but we'll keep it rolling. There are, by the way, there's a mental resource section on the techstars.com/COVID page that I mentioned earlier. So I encourage you to find more resources and discussions that we've already had or have taken place there, as well as other resources. So as the now moderator, I like this question. I get the prerogative of just picking the one I like rather than going with the one Casey would pick. So this one is about the playbook for etiquette during this time. There really is none. Hilani says, what do we do about crafting a unique narrative as a small business owner when you want to raise money, right? But the etiquette is strange. I can't necessarily show up in person. I've got to use, video technologies rather than sort of the classic ways of meeting in person. So how do I manage that? Any great tips you've seen for that, Brad?
I find this an interesting time in terms of engaging with people, because I have for a long time believed that that in-person is overrated. And there's a category of people who really benefit from in-person, and then there's a category of people who it's a real inhibitor. And lots of different examples of it, but one specific one is the introvert-extrovert dynamic. And generally speaking, extroverts have a massive advantage over introverts in person. And it's not just that they might be better or more comfortable in person, it's that they actually get energy from being in person, whereas the introverts, it costs them energy. I think that being disconnected, having to do things via email and video and phone is more of a normalizer in terms of some of that tonality. And as a result, it increases the substance of a lot of the conversations. I have found that there's a weird default modality, which is more and more people want to get together live versus now live via video versus interact via email. So there's a lot more sort of the historical, just email me. There's a little bit of a swing the other direction because people are starved for some proxy for interaction, which I think plays to people who put some energy into it. I would also say that being efficient in the interactions is also valuable. There's probably, in any 30-minute meeting, there's probably 10 or 15 minutes wasted in person of just the logistics and setup and getting seated and getting a glass of water and introductions and passing around business cards and all that sort of shit. So if you can get good at starting quickly, connecting quickly, and then getting into substance, I've found that actually is a real advantage for people, independent of whether they're introverts or extroverts. The endless chit chat that you tend to get in in-person meetings has gone out the door, and I find that more interesting.
Yeah, I mean, what I, being an introvert, what I notice about it and love about it actually is you get a view into the real person sometimes that you're talking to, where you don't before. I was on a call this morning with one of our limited partners, people who invest in our funds, and there were 4 of us on the call, and 2 of us had kids jump into the frame, right? And literally, one was saying, will you take a picture of me to their mom? Right. And she was saying, not right now. And you get to see the real life of that person. And the other one had, it was the LP's kid, and they were wearing a t-shirt and, had been out exercising or whatever, which was not normally how I would experience them or how they would experience me. So you're getting a little bit more personal view into people's homes and lives than is otherwise possible. And so I find that that's sort of replaced the business card thing, is the chit chat about, how you're coping, and maybe a little bit of kid interaction or just understanding their environment, which has actually been really helpful to create a real connection.
Agreed.
All right. What's some guidance for revenue workouts during a time of customer stress? Jem wants to know. What I think Jem means by that is, you have a customer and you're trying to maybe, do a deal. Should I negotiate to gain in the future if I give on near-term payments? How do I maybe think about my customers and giving them a break right now, I think is the spirit of the question.
Yeah, I think if it's an existing customer and you're in a position as a business where you can make accommodations, I think the best thing to do is to basically not just give discounts, but use discounts to extend the length of the contract. So be willing to give something proactively, but ask for something on the other end of it. Interestingly, the biggest challenge for many companies right now is short-term cash flow. And there's actually a very simple solution for short-term cash flow in our overall economic system that nobody is doing. A relatively small number of large companies have made commitments to it, but it would make such a difference in terms of the wheels of commerce, which would be if large companies that had significant cash on their balance sheets paid their bills faster. So instead of paying their bills in 30 days or 45 days, paid their bills in 10 days or 15 days. And it's interesting how such a small thing done on a broad scale would have incredible impact. And there's no way to legislate that, so it's more of a cultural movement. I think that the startup equivalent of that is to some degree is already built in the system, which is instead of having to prepay for things that you then consume over a period of time, you're paying for things on a monthly basis. And then for startups, if you have customers that are under economic stress, giving them short-term payment relief, but again, extending the terminal value of that contract. One other thing to consider, there's a lot of these situations that are untenable. And I'll give you an example of one that just doesn't work, and you have to just sort of understand that when you're part of a bigger system. Every startup that is struggling right now, or any startup that took PPP loans, for example, could benefit from a month or 2 of rent deferment. And every startup I know, if the landlord came to them and said, you know what, you don't have to pay me rent for 2 months, but I want to extend your lease for 2 months, they would all say, yes, done. Like that would be the fastest yes done you've ever seen. Send me the DocuSign. Some landlords are doing that, but the vast majority of landlords are saying no. And at first you're like, fuck you. Like, come on, help me out here. I'm struggling. Don't you want me as a tenant? And the problem is that many of those landlords have the problem where if they do that for one tenant in a building, the word will get around, all the tenants in the building will want to do that. And the landlord actually needs the rent to pay the mortgage because they owe a bank the mortgage. So then you go, oh, well, why don't the banks just do that? Well, the landlords have tried. They've gone to the banks and say, hey, can you give me some mortgage relief for a month or 2? And the banks have said no. Right. So you often have these cascading chains. And that's an easy thing to get your arm around. But as somebody providing services to other companies, think about what the cascading chain of your customer is and try to accommodate something that gives them some help in their cascading chain, whatever it is with regard to your product, which is almost always going to be better than them saying to you, you know what, I don't need your thing anymore. Stop charging me for it.
I love the advice. I mean, you can, turn it into a win-win, right? You have that customer for longer. Maybe that actually is good for both of you, right? And so just you have to think about the dynamic of what you're providing. I've seen some of our companies figure out, how to basically turn goodwill of larger companies that they're working with. Maybe they're saying that's large companies saying that's fine. I'll pay you an extra, few $100,000 to delay the thing that you were going to provide by a year or whatever, because they just want time. And instead they turn that extra $100,000 into a subscription, right? That's every year because they provide some value around it. So there are lots of ways to get creative around, kind of the gives that you can make and that don't hurt you, but actually can help you long term.
I would also say the opposite can be true. When I was running my first company in the 1980s, we had cash flow situations, real cash flow problems a few times. And in those, we were self-funded. We didn't have any capital. And we had some situations where we had actually extended money to buy hardware for customers of ours who then owed us money. So we had actually bought them stuff. In addition to doing the services that we provided, they had the hardware, but we hadn't gotten paid from them, but we had to pay for the hardware. So we had some situations where even though our business was doing well, we had real cash squeezes. We would go to not all of our customers. We'd pick a few that were our best long-term customers and that we knew had financial resources. And we would just tell them what was going on. We would say, look, we're really tight on cash this month. Can you, instead of paying your bill in the normal 30 days, can you just pay it tomorrow? And it would make just an enormous difference to us. And I don't know that we ever asked people to prepay. We may have once or twice, I can't remember anymore, but even that situation where you're asking some of your larger and better customers just to accelerate payment for things that they've done is a good counterbalance to the other side of the equation where you're having to stretch to accommodate some of your customers on the other side. So don't lose sight of both sides of the equation.
Thanks, Brad. Just another reminder, if you have a question, use the Ask a Question button that's on the bottom bar, just so that it gets prioritized. Thank you, Brad, for pointing out it. In the chat, we can't prioritize it because there's others in front of the queue, and we do roll these questions over to future weeks if we don't get to all of them. Here's a good one that I love, 5 votes. Natasha wants to know, how do VCs feel about investing in a startup that is registered as a B Corp, parenthetical benefit corporation? Will we be hurting our chances to get funding by incorporating as a B Corp?
Well, Foundry's a B Corp, so there you go.
So is Techstars.
I think that answers the question. We support B Corps, we invest in B Corps, and we are B Corps.
So yeah,
to be.
Keep in mind, yeah, it is a good thing to be. Keep in mind also that public benefit corp is different. It's a more formal change that usually if you're a B Corp you'll make over time, but there's no reason you can't be a good actor and do good in the world and also, raise money, and investors know that. So looks like we're losing Brad too. So here it is. I'm guessing he'll be back in a minute. Just hang tight, but I'll just keep rolling here. Some home internet problems today. So B Corp's no problem. Wouldn't worry about it. Welcome back, Brad.
Internet's.
No worries. It happens. What does the future of work look like to you in 1 year?
Well, I'm never leaving my house again.
I don't know if you're kidding or not. Actually, I think you will.
I'm not kidding. I don't expect to show up live and in person anywhere till at least 2021.
Does that include personal, vacation?
Yeah, I'm not going anywhere.
Wow, that's a while. So we are thinking a lot about that across Techstars, and planning an accelerator focused on this space, as you might guess. Why not? And a lot of people have suggested one, so we've taken them up on that and have one coming that'll be pretty exciting. So watch Twitter at Techstars for more on that if you have thoughts on how that'll work. Let's see. What will EdTech companies look like in the future?
EdTech is a category that is fascinating because as a historically investable category, it's been complicated. There have been some significant successes. There have been lots and lots of venture money poured down the drain. And In the last 4 or 5 years, there were a handful of funds raised that were focused on EdTech specifically and quite intelligent in terms of the types of investments they made. I would say that the interesting dynamic with EdTech that nobody expected, at least I don't think anybody expected, was distributed education, teaching, by video, virtual classrooms, like all that stuff is in the mix. I don't think there was real anticipation of the complete disruption to the entire functional way that education works because of the inability to be in physical space together. I think there was a lot of augmenting that, but it was always against the background that there would be education physical space. I've got a couple of people I know, one in particular whose kid goes to an online high school. So not homeschooling, but actually a high school that's entirely online, Stanford Online High School. And it's fascinating to watch how he engages with school versus how he engages socially with others in the physical world. But I think this is the essence of the shift, is that most of the tools and most of the infrastructure still assumes that there is a traditional classroom infrastructure experience. My wife's on the board of her college, the college she went to, Wellesley College, and sort of listening to some of the conversations about college, and so just not K through 12, but college sort of in this context. And what is the purpose of college and the college experience separate from the educational components of it, and how the experience is part of the educational component of that time in your life? I don't think anybody's really processed what any of this means if you don't have that physical, whether it's a classroom experience or not just classroom experience, but in-person thing. I mean, imagine if there is no NCAA sports in the fall. Imagine if there are no high school sports in the fall because of the dynamic of the virus and social distancing and that sort of thing. What does that do to the overall educational experience? I don't have good answers. I just think it's a totally fascinating place to look. And I would encourage people who are entrepreneurs there not just to be looking at the proxy for teaching in that moment, but the whole experience of what somebody gets out of educational dynamic, which, by the way, includes the engagement with teachers, mentors, parents, not just your other students and your peers and your educational material.
Yeah, huge plus one on that. I mean, the experience as a parent is bad. I have a 10-year-old that sits in the next room here and does his school, and it's all on Zoom, and there's all that, which is not, even if there weren't any issues that are being talked about, right? It's not the right tool, but it's what everyone's using. Kids are chatting in the background, right? And they want to stop that, and the teachers don't know what's happening. And as a parent, you have no idea what's happening when. And so just the organization around it can be a lot stronger. Brad, one more here, and then maybe we'll move to the sort of rapid fire piece and try to get through more of these quickly. But what are your thoughts on the shift from profitability versus scale and sort of debt funding and equity as it relates to hey, it's not just build it for growth and don't worry about revenue. Is that shifting? That's something Martin would like us to address.
Yeah, for sure. So for the last, 3-4 years, the venture world collectively has been completely focused on growth, independent of what the costs are. You hear VCs talk about things like unit economics and stuff like that. But basically, if you're not growing at least 100% year over year, for many VCs, especially growth-oriented VCs or sort of mid and later stage VCs, your company's shitty, which is nonsense, because you could be a 50% or 75% growth company and doing quite well economically, and your business could be valuable. People were just focused on growth at any cost, and as a result, the spending, not surprisingly, got very out of whack because capital was available at attractive prices to the entrepreneur for any company that was demonstrating that they could get extraordinary growth. There were a lot of rationalizations in that mix. The rationalizations included things like, if you're growing fast enough, you can always fix your unit economics later. It was a market share game, so you really wanted to build enough critical mass as fast as you could, so investing the capital now is key. The extreme cases, and you saw it with several of the very, very high flyers that have subsequently blown up. WeWork might be the poster child for this, but there are plenty of others that were businesses that really fundamentally didn't work from an economic perspective, but they were able to, because of the vision they have, raise capital at such a scale that they deployed that capital independent of their businesses. Now, some of those companies still have a lot of capital, and so they're trying now to engineer their way into businesses that work. Maybe they will, maybe they won't. But that's corrected far the other direction, partly out of necessity, because the amount of capital, while there's plenty of capital available, there's much less tolerance, I think, by VCs of throwing capital at companies that don't have fundamental economic businesses. I would also say the flip has changed, which is that having capital and having a durable business is now much more important, because you're going to have a lot less competitors, because many of your competitors will go away as a result of the downturn. And so making sure that you're using this time period, especially if you have a lot of capital, to really shore up the quality of your business so that when there are growth opportunities again, your growth is much more economic. Last comment to make on this, same thing that's happened in all the other downturns I've been involved in. Cost to customer acquisition generally goes way down in a downturn. And I think I know companies in our portfolio are already seeing it, all the online advertising costs, whatever your metric is, in terms of CAC or, however you're doing your ad buys, those numbers have gone down quite a bit. And so it's a lot easier, not just because there's less competition, but there's just less demand for certain elements of that. I think the channel dynamics have shifted as well as you move towards, especially if you're selling anything that's physical, shifting towards more online channels versus physical distribution channels, because stores are closed. You realize that you get some great efficiencies out of that if you can sort of navigate that as well. So it's sort of cost structure for acquiring a customer, CPMs, things like that, are less expensive. And so as a result, you can start to build more rational things. There's some great stories. I don't know if people here know the Netflix story, but one of the reasons that Netflix had immense growth post-internet bubble was because you could basically get online advertising for almost nothing. And Netflix ran ads everywhere, and they just sort of became the dominant play of online video in that moment in time. And they used the downturn to their advantage in terms of that.
Awesome, Brad. I want to shift. I think we have about 6 minutes. Let's do a little bit of rapid fire here because there's still 20 questions. A couple questions I'll integrate. What are the trends you're seeing with financings and M&A? And I've actually got a blog post I'm going to throw in the comments that shows the trends from Techstars, what's happening to financing and M&A activity. But maybe the part I'll toss at you quickly is are you seeing any predatory behavior from other VCs in general?
There's some, people are going to behave how they, their nature, whatever the scorpion and the frog cliche is that is, I've been hearing since I was like 4. And there are some investors who can't help themselves. And they can't help themselves because, the second there starts to be some pain in the system, they take their knives out and they start carving up whatever they can. I don't think it's been that extreme yet in terms of pure predatory behavior. We've heard a few cases of VCs who had term sheets out that then retraded those term sheets substantially. I would separate pulling from retrading, right? The pulling is saying, you know what, I decided I don't want to do this deal. Okay, that sucks, but that's your prerogative until the deal's done. The retrading is, I was going to do this deal at 25 pre and now I'm willing to do it at 5 pre. It's like, what? And so there's that. And I think, reputations are made by behavior in downturns. And the reputation is not that you should necessarily follow through on everything that you say, because there are situations where you're like, you know what, I'm not comfortable doing this anymore. The things that changed in the last 3 weeks were dramatic enough. But just using the fact that things changed in the last 3 weeks is not necessarily a good reason to retrade deals and to behave in a predatory way. I'd say the opposite is true too. There's been some investors, especially at the later stages, that have followed through on their commitments been very clear that they were not going to retrade what was going on because they believed in the company and they made a decision to invest in the company at a certain point in time. And I have a lot of respect for those decisions.
This one's aimed at you, Brad. It says, Brad, your blog this morning on Feld Thoughts is very relatable. What are your recommendations to founders during these uncertain times as it relates to fundraising or pivoting to survive?
Just know it's going to be hard, and that you're not alone, and to take care of yourself. I mean, it kind of goes back to what we said earlier. I mean, one of the things I came out of this weekend deciding, I love to run. I have not been running very consistently. I don't even really care how fast I run, and I've got a good place to run at my house because I've got 40 acres. So I've got a loop that's about a mile loop around the edge of my property. And I'm like, why the fuck am I not doing this? Like, it's something I really like to do, and like even if I walk a couple of laps because I don't feel like running today, like just like allowing myself to have whatever functional physical release, the exercise, meditation, spending time with your family, spending time with your friends, not feeling like you have to always be connected and always on email. I mean, knowing that the work is going to be really hard right now. And if you know that the work is going to be really hard, making sure that you have some not work time is key. I think the thing that is most dangerous right now, and I use this phrase over and over again, I call it magical thinking. The magical thinking that somehow things are going to be okay is really a dangerous thing. It's if you say, okay, at the end of May, everything's going to go back to normal. And then we get to the end of May and it's not back to normal. That's really hard because you had this expectation that end of May was going to be really back to normal. It's easier to say it's going to be hard for a while. I don't know how long. And I'm going to have to deal with that for I don't know how long. And I'm going to deal with it day by day the best I can, but make sure I give myself enough time and space to take care of myself in the midst of this hard work.
Yep. Thanks, Annette. We have just a couple minutes left. I'm going to get one more in, Brad, because I know I want to run you right to the hour here.
It's okay. I don't have very far to go to my next meeting. My next meeting is right there.
It's all about time to go to the bathroom, which you don't get either. Seems like a lot of companies funded before March 2020 are in a tough spot, having benefited from record valuation. Should companies be in a mindset to take a valuation haircut in order to survive?
Sure. I would say step one is not worry. If you've raised money relatively recently, don't worry about the valuation dynamics. Worry about making your cash last as long as it can and using the cash that you have to build the business that has the most long-term value, recognizing that nobody's going to pay attention to your growth rate right now. They're going to pay attention to what you did in this moment to put yourself in a position so that when the economy was stronger or when your business was in a position to grow, it did. The next thing is, even if you're have raised money a while ago and you're needing to raise money again now, your last valuation mark generally isn't meaningful. And one of the things that happens in the situation we've been in, is people don't pay any attention to your last valuation mark because you have a competitive deal. If you have 5 people chasing after your company, you're going to get an upper round based on whatever the market multiples are and however much competition you have. The flip side is true too. When the markets get tight and nobody's chasing after your deal, that last financing didn't really matter. And so measuring yourself against your last round of financing is not that important. And what's more important is to recognize that whatever capital you have, you want to use it to make as much progress as you can. And if you need to raise more money, you want to take the least amount of dilution you have to take to get the capital that you need to keep going. So it's less about what your valuation is as a private company today and much more about the resources you have and the progress you're going to make.
Great advice. Yeah, I think people focus too much on the pricing and this one deal, right, as opposed to their long-term potential. So we'll keep people focused on that. Brad, we'll leave it there. I want to thank you for joining. You can see in the comments, we got people asking you to come back and be on the weekly AMA.
Any chance I get to hang out with you on a pane of glass works for me, man.
It's amazing, right?
Casey, we missed you, but it's good to see you in the back.
Casey's watching. She's not missing a thing. She says all of Denver's having problems for some reason. But I'll just remind everybody there are 6 or so Techstars demo days this week. and there have been many more recently, and you can attend them all now. They're up there for 2 or 3 weeks on Techstars.com. So hopefully you'll go to demoday.techstars.com and check those out, and we'll see you next week on the Techstars Community AMA. Thank you, Brad.
Be safe and healthy, everyone.